2, 1. How's everybody doing?
All right. Getting close to the end of March.
Heck yeah, man.
Getting warmer outside. Well, not this week, but.
No, it's not warm right now. I don't know where you guys are at listening to this, but it's freezing in Virginia.
It is. It is cold out there right now. Crazy. Last week was like 70. This week is like in the 20s. It's crazy.
Yeah, hopefully we don't get any snow.
Oh, no. All right. So we got a lot of stuff to do this week. We're going to take a look at 2 questions I got in the Facebook group this week, and they're pretty common questions. We'll take a look at that, and then seasonal strategy. So we talk quite a bit about Stock Trader's Almanac, and there's a pretty simple like a seasonality-based strategy you can use if you only wanted to trade twice a year, basically. So the idea is to be in the stock funds during what's historically the best 6 months of the year, and out of the stock funds during what is historically the worst 6 months of the year. And since we're coming up on April would be the month that you would transition out of the best 6 months of the year, we'll take a look at that. So give people a little heads up if they wanted to implement this strategy. And then we're going to do a follow-up on Bitcoin. We did Bitcoin 2 weeks ago as a bonus chart, and we'll see what's happened since then. And then the C Fund weekly chart. So one of the common questions we get. New to the group, recently joined because I have a TSP account with little to no growth. I want to be a bit riskier this year.
Oh, boy.
Yeah, I mean, these kinds of questions always make me cringe because it's all personal, right? And we're gonna kind of talk about that. So little to no growth is a relative statement, right?
Yeah.
You have had little to no growth. Let's say you're 100% in the C Fund, and you're taking this from the top in January 2022. You've had about 10% growth.
Yeah. First of all, did they give all that information?
No, this is it. That was the.
Yeah. So that's where we got to start, right? Is right. Like, well, and everybody hates this answer from us, but the answer is it starts with it depends.
Yeah.
Because it depends. Where have you been this whole time? Have you been in
right.
G this whole time? Okay, maybe I can. Okay, you haven't had a lot of growth because you've been in the G Fund.
Right.
Where have you been, basically? Where have you been so we can get a sense of why you haven't had, and then what is your idea of growth?
Right.
And what are you expecting to get out of? And that's where you're getting ready to
yeah.
fill in the blanks there.
Yeah,
but
yeah.
you gotta give us more information. Not that we're going to be able to give you the right answer, but we could give you a better answer than just telling us, "Hey, I want to be riskier." And I know they probably weren't asking us specifically.
Right. No, it's to the group.
That's into the group, which is dangerous.
Yeah, we're going to talk about that a little bit too.
All right.
But yeah, what does it mean to be riskier? Okay, so first of all, it depends. When you say little to no growth, it depends what you. If you were in the G Fund, you were getting little to no growth. Even though the G Fund has been getting more growth in the last couple of years because as rates go up, the rate of return of the G Fund goes up. But relative to the C Fund, the G Fund is not getting a lot of growth, right? But in 2022, you were getting a lot of growth in the G Fund relative to anything you could have been doing in any other stock funds. So it depends where you are, what your starting point is when you say little to no growth. What does it mean to be riskier? Let's assume you're in the middle of your career or early in your career, and you are contributing to TSP. You're maxing it out. You're getting the 5% matching. You can be riskier personally because you have time to recover from losses. If you're later in your career, you don't have so much time to recover from losses, right? So riskier can either be a personal perspective or a market perspective. And the way we look at it is from my perspective, the way to look at it is the market determines the risk, not you. The market doesn't care about you. The market.
It's definitely not moving up or down or sideways based on your situation.
Right.
Right. I mean, that's when people hear us say like the market doesn't care about you, it's literal, meaning the market has no idea who you are.
Right.
Right? It's
I
not.
mean, and that's obvious. It
It's
sounds stupid, but
it sounds mean or kind of condescending or something, and it's like no. It doesn't respond to any of us. It responds to the collective us as investors,
yeah.
right? But no, it doesn't move up, down, or sideways based on what's going on in your life.
right. It's which is what amazes me about the retail financial industry. The whole idea is you build your models based on your circumstances and your goals, and you have to do that. You have to have a personal plan, but you have to apply that plan to what the market's actually doing.
Yeah, and that's what advisors are supposed to do for you, right? And this is the dirty little secret. I know we're getting ready to go off a little sideways, but you brought it up.
Yeah.
If you open the door, the door is, and if you're new to us, really dial in and listen for a second, because this is important. The financial industry is built on first of all, the system is generally built not necessarily to protect you.
It's built for them to make money.
Well, yeah, it's built for them to make money. Them, the bigger they. But more importantly, is they have to give they are supposed to take care of you and your interests. So the way you do that, the way they imply that they do that is by asking you your personal circumstances, right? And so they write all that down and basically build a plan based on that. That, from a financial planning perspective, is absolutely a great idea.
Yep.
100%. Absolutely, you should do that. As soon as you move over to the investment advising world, which most of this kind of like gets a little gray, right? Is the person really my financial planner, or are they an investment advisor? Are they trying to sell me commission products or things, or are they just, basically they want my money because that's how they get paid. Right. If you're paying a person a fee-based to do financial planning for you, you've probably got a decent person. That's the right setup.
Yep.
If you're paying someone by how much money you give them into an account, that's called assets under management, you need to take a step back and think about what their priorities are, right? And so this isn't a negative to either side. The takeaway here, though, is the system is built to basically give you a feeling that your personal circumstances matter. And they do when you're planning your financial life.
Yep.
They don't have any impact on the market. And so you have to be and this gets a little technical, you have to be in the asset class that's staying level or moving up. That's the best you can do. Yep. And if you're in one that's going down and somebody's making excuses for it and saying, well, you got to stay in the market and buy low and all this kind. Yeah. No, red flags should be going off, right? I mean, that's not how you should be managing your investments. I mean, Jerry's going to get here in detail a simple way that we do it by, with these charts.
Yeah. From my perspective, the only way that you can figure out risk, once you've gone through your personal planning and all that, and you know where you are personally, once you have done that, the risk is opportunity cost and actual loss. So opportunity cost, meaning if you're in the G fund and the market's going up, you're not losing any money, but you're not getting the gains either, right? Actual loss would be if you're in the stock funds and the market's going down, then you're taking those losses.
Right.
So that's where the risk is. It's not about you personally. It's where your assets are allocated. And in the TSP, it makes it easy because you're basically in the stock funds or you're not in the stock funds. That's more or less all there is to it.
Yeah. I mean, and back in the day, you could count bonds versus stocks. Those don't necessarily aren't going inverse like they used to.
Recently, no. I do have a chart that's coming up on that, but there are times you can use the F fund, but lately the
good thing is the TSP makes it simple. The bad thing is the TSP makes it simple, right? You don't have a lot of choices, right. So that can be a good thing. I think the intent, by the way they built the TSP, was probably a good thing. I really do, because you can't have so many choices. That's part of the problems we run into with people that ask us about 401k. Yeah. They get a list in their email, a PDF of 50 choices that their employer gave them that they can, and half of them, they don't even know that half of them are just duplicates. Right? Or some varied variation of the same thing. And so that's even more complicated. At least we got it whittled down to 5, And all things considered, they're not bad choices. They give you options. We have a great option with G, which it gets, it really gets pounded on by a lot of people, and that's, it's a good option sometimes.
Yeah.
When everything else is going down.
Yeah.
Why not be in the G?
I mean, if you look at them as tools, I think it's a better way to look at it. You want to be in the G fund in certain market conditions. It's not that you want to sit there all the time because you're not getting a lot of growth in the G fund. But when the market's going down, it's the place that you can be where you do actually get some gains. Okay. So that's the idea of risk, market versus personal. And then charts really are what you need to kind of focus on. So I started at the top before COVID on this one. So this is a chart of the C fund, right? S&P 500 is our C fund. Each tick is a week of price action. Okay, so 1 week. So what I did was, this is a percentage chart. So the 0 line was the week right before the crash in COVID. Okay, so if you were in the G fund, or the C fund rather, at the bottom of COVID, you were down, a little over 30% at the worst. So if you're talking about little to no gain, if you were in the C fund the whole time, starting the week before the COVID crash, you're up 56% as of the close of this week. So that's a pretty big move, and it's the best that you could have done, because we'll show this. The C fund outperformed the S fund over that time period. So the best that you could have done was to be 100% C fund over the whole course of that time, right? If you were going to be in a buy and hold kind of scenario. If you're talking about from the top in 22, you're up about 10%, a little more than 10%. So it really depends on where you begin kind of to look at it to say that you have little to no gains. Okay, so the C fund has done really well, right? You're up 56% from the top before COVID. This one is the S fund and the C fund, okay? So it's the same weekly chart. This time the candlesticks are the S fund. So everybody likes to say that you should be in some kind of combination of the C and S. And generally speaking, right, this pattern, we started at the same place. So generally speaking, the C and S funds go up and down together, right? There was definitely a time, if you guys remember, in 2021, the S fund was down here, having been down, more than 40%. And then it rocketed up to that top in late 21. It was like 100% gain, right? Because you started down here at minus 40 something, you ended up here at over above 50%. So it was like 100% gain from here to here on the S fund. And everybody was really excited about the S fund. The C fund didn't do as well, but then we had the pullback correction in 22. And since then, the C fund has been outperforming the S fund. Right, so now everybody is 100% C. That's what you see in the Facebook group and a bunch of groups around.
It's easy to be 100% C right now. It's going up.
Right, right.
If you're 100% C when that chart's going down, you're in a different narrative.
Clobbered. Yeah.
It's a different narrative. So I just always like to point out the both sides of that.
Right. So I mean, the risk, like, it's one thing to say what is the risk when the market's doing this. It's a much different thing to say what's the risk when the market's doing that.
Yeah, when the market's going up, you've got opportunity risk.
Yeah.
Meaning if you're not taking advantage of that opportunity, that's what you're risking. And sometimes that could be very difficult, especially if you were not engaged, right? You weren't being active, so you weren't really paying attention. Now all of a sudden, let's say you're in the middle of this, what we're in right now, which is one of the longest, uptrends in a long time. Yeah. And where are you at in that tree? You don't know. So you're like, do I get in? Do I, and there's that fear of missing out.
Yep.
And also that a fear and anxiety of like, if I get in, is it, well, the good thing is, and I try to get this across to people, again, this isn't personal advice. It's just, a perspective that if the market's trending up and you're not in it, get in it, because the worst thing that can happen is it turns over and you go back to G. You can always go back to G. Yep. That is one of the nice rules about TSP is they allow us, no matter how many moves we've made, your last move can be to G. You can reduce. You can continually reduce to G. So you
throughout the month, right?
Yeah, that's not even really 3 moves. You could move. You could be in C, and gradually pull back every other day
Yeah, sure.
into G, right? There's a bunch of variations of that. But the point is you have a safety net. So why sit on the sidelines and watch that? If you missed it because you weren't paying attention, you know, the opportunity risk is huge. You know, you're missing out on an opportunity to get that. Now, you know, back to this person's question, or you know, or statement, you know, whatever it was. Let me put the chart back up there. So, you know, like Jerry's saying, like, what's the risk? The risk right now is that you're not in the stock funds, right? Particularly CNS. And what, you know, and you were talking a minute ago that you would put them in balance in between the two.
Mm-hmm.
We don't always do that, but sometimes we do. If you don't see, and if you go to our website, if you're a member, rather, in our charts that we list, we have one that's called ratio charts. Mm-hmm. And it'll give you a chart that shows you which funds are outperforming the other one.
Yep.
And at times they're kind of going back and forth. So that would tell you, okay, I can't really pick which one, so I should be spread across. You know, CNS is a good example, but sometimes it could be, you know, could be S&I. There've been years where they've kind of gone back and forth. But those ratio charts are really useful for that. But barring an overwhelming what's the word I'm looking for?
Direction by one or the other.
Yeah. Barring that, you know, being spread out is not a bad thing, but you're also not going to get as much of a gain relative to which one is going up at any given time as fast. So that's kind of tough to watch too. If you're watching the C skyrocket and the S is gradually, you know, keeping up with it, you're not making quite as much. But this whole idea of risk is very complicated until you drill it down, like Jerry's pointing out now.
Yeah. Okay, I know. I got one more. Okay. So that was the idea of the C and the S. This is what we're talking about the F fund. So the idea is that of the 60-40 portfolio historically has been, generally speaking, when stocks are going down, bonds are going up, right? And when stocks are going up, bonds are going down. That's not exactly how it works, but that's kind of the idea, is that stocks are going up most of the time, and so if 60% of your portfolio is in stocks, you get the majority of those gains. A lot of times when stocks are going up, bonds are also going up, just not as much. But when you have big drops in the stock market, the bond market tends to be flat to up. And there are times when stocks go down and bonds go up. So bonds, in our case, is the F fund, right? So we don't have a lot of examples of it recently, but I pulled this chart from, we're going from like 2007 to 2012, when at the beginning of the great financial crisis, it was the top in 2007, the F fund had been moving higher, right? When stocks started coming down, the F fund really started moving higher. And this gain is much more than what you would have gotten in the G fund. So the best place that you can be, you know, from, say, October to March, right? October of 07 to March of 08, which is, you know, six months, pretty long time. You would have, if you were in the F fund, you would have avoided this big drawdown in stocks, and you have gotten a much bigger gain in the F fund than you would have gotten in the G fund. So the idea of constantly comparing the funds to each other is the technical analysis way that you would determine, you know, the quote unquote risk of which funds to be in. Obviously, when, you know, you draw a trend line, we broke the trend line here, came up and retested it here, and then the market rolled over. So from that candle right there, there was no reason to be in the stock funds. And if you're looking for an alternative, yeah, you can go to the G fund, or you can look at the F fund and say, hey, it keeps putting in higher lows and higher highs. The trend is up in the F fund. That's probably a pretty good place to be while the stock funds are going down. And we got, you know, when Lehman collapsed and we had the big, you know, what they actually refer to as the great financial crisis, that part of it, which is pretty close to the end of the bear market, which actually ended in March of 2009. But the F fund, people flee to the safety of bonds. So the F fund, you know, really went to the upside as stocks continued down. And then again in 2011, stocks peaked, you got a triple top there. That told you everything. That candle right there, and the F fund is still moving higher. So there are definitely times when you want to be in the F fund, but it's a tool. You don't want to be in there all the time. It's a tool. All right. So the next one is also very common, and it's probably more important for people that are close to or in retirement in a market like this. So new to the group, recently joined because I need some advice to grow my TSP as fast as I can. Because although I've worked for the post office since 2010, I've only been full-time since 2016. So I assume from that, I don't know if you can contribute to TSP if you're part-time, but I'm going to assume that you can only contribute if you're full-time, which means, this person started contributing in 2016. So probably not a whole lot already in TSP and trying to grow it as fast as they can. Any help is appreciated. Also wondering what percent should I be contributing? I'm a one-income household. So the last part of it is actually the easiest. At an absolute minimum, you want to be contributing that 5% so you get the 5% matching, right? If you're over, this person was 60, so if you're over the 50, right, you can start contributing more. It's a catch-up contribution. So the bottom line is, at an absolute minimum, contribute 5% so you get the 5% matching, because that's 100% rate of return on your money.
And after that, give as much as you can.
As much as you can, yeah.
That's the real secret. Is give as much as you can and try your best to meet that minimum 5%.
Yeah, and that comes back to what you were saying about financial planning. So it's I'm a one income household. That's where the financial planning comes in. You sit down and figure out what your bills are and what your goals are and how much you can afford to contribute to TSP to try to meet those goals.
Yeah. So right now, if you don't have enough to meet that 5%, this is just an example. If you don't have enough to meet that 5% goal, it's got to give somewhere else. Yeah. Right. So, and I'm just making this up. I have no idea this person's personal circumstances. But let's say you got a motorcycle, you got a boat, and that's $500 a month or something that you're paying it. And you're looking, okay, well, your financial planner is going to say, okay, which one's more important to you? Right. Do you want your retirement account to maximize, or do you want to keep the boat? Oh, I'm selling the boat, and I'm going to roll that $500 a month, including what I'm already going to do, so I can hopefully make that 5%. That's just an example. That's what a financial planner would do, is give you the tools to say, look, here, you're telling me this is your goal, yet here are things you're spending your money on, right? And so do you want to keep spending your money on these things, or do you want to do this? And that's what a financial planner is golden for. Yep. And then, it may be a different person, but then you want someone to manage that investment for you. Sometimes that's not always the financial planner. Many financial planners, if they're completely honest with you, don't really want to be investment advisors, because that's not where they focus on all the other stuff we just talked about, getting the best, lowest tax rate, helping you find savings within your budget, and all those things are extremely important, but they're not necessarily, portfolio managers. Right. It's a very different thing.
It's two different things, right?
Yeah.
So once you figure out how much you can contribute, the minimum should be that 5% so you can get the matching, and then as much as you can do. The part of the question that just it's very difficult in this kind of market. I'm late in my career. I'm seeing the market take off. I want to grow it as fast as I can. How do I do that? There's only 5 options. So forget about the mutual fund window, right? There's only 5 options in TSP. You got 3 stock funds, a bond fund, and a money market. And so you can only grow it as fast as the of those 5 funds, whichever one is going up the most. If you are in that one,
you can only grow as fast as the market does.
That's it.
It's the only option.
You can't. I mean, you can't speculate in TSP, right? That's all you can do is those 5 funds. So the thing to think about if you're late in your career or in retirement, this is the chart you have to keep in the back of your mind. It's great right now. So this is a monthly chart. Okay, each tick is 1 month, and we're going back to 1996. Nobody wants to look at it this way, but if you're in retirement, you really should. You're looking at basically a 30-year chart. Okay, if you're in the market here, that's awesome. You're making huge moves, right? If you retired somewhere around 2000, and you were 100% C fund, because this is the chart of the S&P 500, the market came down 50% of its value, came back up to the prior high, down again 55% of its value, back up to the prior high. Okay, that whole, W took 155 bars. Each one of these is a bar. It's 1 month. It was 14 years, right? The peak was March in 2000, and you got back to even in March of 2013. It took 14 years. So it's one thing if you're employed and you're contributing and you're watching the market go up and down, and that's fine. In general, the trend of the market is up. But if you're retired or close to it, and anywhere in here, especially if you're drawing down on TSP in retirement, you're in a much different place than you would be if you were employed.
And people that don't remember that time frame, and that's a 14-year time frame, which if you were in the government, or even not necessarily in the government, but if you were just paying attention to the world, you saw that happen. And so here's what really drives me nuts is we're so fickle. We have such short attention spans. It's short memories, right? Because everybody pretends like that can't happen again. And it absolutely will happen again.
Yeah.
It's cyclical,
yep.
right? It might not happen twice in a row like that, but it very much could. And even if you just took one of those dips and back up, that's the what's that? How long was that first one? I forgot the
2000 to 2003.
Yeah,
3 years there, and yeah.
So it's a long time, a long time to watch that play out. Now, of course, we would argue that you don't have to be in the market as it goes down. Right. And if you watch our show and you're a member of our site, then you know that, right? So we think there are options, and there's better options in doing that. Now, you're not going to catch the bottoms, and you're not going to catch the tops, but you're going to do your best. The takeaway here, though, is what Jerry's pointing out is that risk is huge, because if you're in retirement and we're there, and the market takes a huge dive, and I just stay in it because I feel like I have to, and I'm not contributing, that means the money that I'm maybe living off of is going down significantly. It goes down 50%. I mean, that's amazing. I wouldn't. Let's just say it's 20%, right?
Yeah.
Let's say it's not as big of a dip as that. Although you can see it happen twice in 14 years, it very well could happen again. Particularly with the situations that we have going on with regional banks and commercial real estate, and there's a lot of things right now that the bubbles could pop. And so if you're sitting there trying to live off that money and it's depleting every day without you even taking any money out of it, it's a huge risk. And I think the argument would be is that you just got to be actively managing this. Now, you could take the route that many people do when you retire and hand that money over to a financial planner or investment advisor, particularly an investment advisor that actively manages the account and keeps you out of those kind of troubles, right? You roll it over into an IRA and you let them deal with it. But if you're keeping it in the TSP for whatever reason, and there's plenty of reasons to keep in the TSP, then you got to manage it. You've got to. If you don't, you can find yourself on that chart somewhere, and it'll be very painful.
The thing is, so you were flat for 14 years. Right, and over the course of that time, if you're in retirement and you're taking that money out, this is your account is decreasing, right? But let's just say you kept it in the C fund the whole time, so you're flat for 14 years. Then you have a pretty big up move, and then you're flat for 17 bars. So what is that? Almost 2 years. Then you have another big move up, and really from here to here, you're flat again. Yeah, this is another 2 year flat right here. You get another big move up, and then from the top in January 22 to January 24, which is when the C fund finally got back above its prior high, you were flat again for 2 years. So you get these big flat, long-term flat moves interspersed with big moves to the upside. right? And obviously you want to be in the stock funds during these big moves to the upside, but you don't want to be in the stock funds during these big moves to the downside. So the bottom line to that person's question is, I want it to grow as fast as I can. It can only grow as fast as the fastest of our 5 options, and right now that's the C fund. I mean, it's been going straight up. We'll get to a chart of that at the end.
Yeah, and I'll add to it. There's 2 ways to make it grow fast, right? One of them is you put as much money in there as you can.
Yep.
Because your contributions, like that first 100,000, is probably the slowest, right? Because you get the compound interest really starts kicking in. You know, the compounding, not just compound interest.
Yeah.
Compounding really starts to kick in. That snowball effect around 100,000. 100 to 500,000, it's moving a little quicker.
Yep.
Once you get to that 500,000 mark, it really picks up speed, particularly if you're well invested in the market when it's going up. Yep. You're conserving your funds when it's going down. You know, even if you're just out, and you know, you're kind of going back and forth. You're definitely getting just about the best gains you can possibly get, but you have to contribute. So the market's got to be on your side, like Jerry pointed out. But don't forget, like, really, the fastest way to grow your retirement account is put more money in it.
Yeah. And
that will help when the market is working in your advantage, because you'll have more compounding going on.
Yeah, it's all the percentage. I mean, you know, obviously 10% of 1,000 is 100. 10% of 100,000, you know, is 10,000. So it's all,
the more money you got in there, the better.
The faster it grows, yeah. All right, so hopefully that addresses at least some of that. So let's say you're not worried about growing it as fast as you can. You just want a pretty simple system. You know, like I hear you guys, active management is the way to go, but I don't have the time or the patience or the interest. So
this would still be active management. It's just less active.
Yeah, less active. Yeah. So if you buy into this idea of seasonality, and there are plenty of resources you could take a look at. This one on Stock Traders Almanac is just a very simple way to do it. So generally speaking, the best 6 months for the S&P 500 are November 1st. So November through the end of April are the best 6 months historically for the stock market. May 1st through October 31st are historically the worst 6 months. So the idea is that you would want to be in the stock funds during the historically best 6 months and out of the stock funds during the worst. So they call it you can go see it here at stocktradersalmanac.com. You don't have to be a subscriber to take a look at what the strategy actually does. So they call it the tactical seasonal switching strategy. And like we said, it's derived from the best 6 months, which we just said what those were. Switching strategy it's in the annual Stock Traders Almanac, which you can buy. It's really it's a good resource, and you basically flip-flop. It's basically the flip side of the old sell in May and go away adage, right? A lot of people have heard of that. After decades of historical research, we discovered that the most market gains occur during the months November through April. So investing in, he's saying the Dow Jones Industrial Average, it's close enough for us to the S&P 500, our C fund. Between November 1st and April 30th each year, then switching into fixed income, which for us we would say the G fund, for the other 6 months has produced reliable returns with reduced risk since 1950. Don't have to read through this whole thing. That's the idea. This is kind of an important one. Exogenous factors and cultural shifts have to be considered, right? If you look at back tests that go back to the early 1900s, late 1800s, there are times when the pattern doesn't work. And he's saying it's best to ignore those times that pattern doesn't work because they're for specific reasons. Like farming made August the best month from 1900 to 1951, right? So there are things that happen that change the pattern. And he's saying if you can identify those things, then it's better to kind of ignore them. Since 87, it's the second worst month of the year for the Dow, right, is August. So if you're just looking, because farming isn't as important as it was in the early 1900s, so since 1987, August has been the second worst month. panic caused by the financial crisis from '07 to '08 caused every asset class outside of U.S. Treasuries to decline substantially. The bulk of the major decline in equities in the worst months of the 2008 crash was sidestepped by using the strategy. The best months, switching strategy, will not make you an instant millionaire, as other strategies claim to do. What it will do is steadily build wealth over time with half the risk or less of a buy and hold approach. Okay, that's what he's asserting in this tactical switching strategy, is it's relative to buy and hold. The strategy is used in conjunction with the MACD indicator to confirm or assist in timing buy or sell decisions. So once we enter April or October, we begin tracking MACD for confirming buy or sell trigger signal and issue an almanac investor alert when that occurs. So this is the chart from Stock Traders Almanac. What they're saying is if you are in, he's using the Dow Jones Industrial Average, but for our purposes, the C fund. If you are in the C fund only for the worst 6 months of the year, going back to 1950, okay, your account would have been negative if you were in the C fund only for the worst 6 months of the year, and you averaged it out over that time. If you were in for the best 6 months and out for the worst 6 months, you'd have been up quite a bit, right? And if you were buy and hold, this is where you were. Okay. So I pulled up this chart. We've talked about it quite a few times. We have a stack that we use that it includes the MACD, which was referred to a minute ago, is what they use as a signal to either buy or sell. So what you would do is you're looking at the market and you're in the month before, let's say, this is November of 2018. What you're doing is looking for a reason to get into the market, right? Because from the beginning of November, that starts the best 6 months of the year. So starting in October, you're looking for a buy trigger. So in this case, the market had been going down in October and started to turn up. And when we got a buy trigger, that's when we would buy and go from 100% G fund to 100% C fund on that day, because we got a buy trigger on November 7th. Okay. Then, so you're staying in there. You're holding in the C fund during those best 6 months of the year. And then in April, you're starting to look for a sell trigger. So in this case, we got a sell trigger on May 7th. We didn't get one in April, right? The market had been going up. We got our first sell trigger on the 7th of May. Okay, so then you're going to go from 100% C fund to 100% G fund and ride out the worst 6 months of the year. Okay, so that's how you would implement the strategy. And basically over the last 5.5 years or so, if we looked at it, you got into the stock funds here, into the C fund, let's say here. You got out here. So you made a little bit of a gain, more or less flat, basically because we had this big down move. Then you were out during the worst 6 months of the year, which in this case, the market basically went sideways, so it didn't make a difference. You got back in October of 2019, had a big move up, but then we had COVID. Big move down, and then COVID recovered, and you got out because that was, if you're implementing the strategy, that was the first sell trigger, was May 2020. And the market went up. So you're really frustrated because you were out of the market during that best 6 months of the year, or during the worst 6 months of the year, but in this case, the market went up, right? You get back in on a buy trigger in November 2020, best 6 months of the year, the market's going up, right? So you had a big move to the upside here. That was great. This one was basically flat. You were out. This one was more or less flat. This one, you were out of the market. You got back in down here. So you saved yourself the majority of that move to the downside in 2022. Okay. You're back in here. You got this big run up. You got out here. This one was basically flat. And you're back in for this big move that we had since October of last year. So it's not 100%, but it's pretty good.
And back to their explanation of the strategy, when you see that dip with COVID, you have to just accept that's an anomaly, and that caused the seasonal part of the strategy to kind of self-correct, and that's why you could see there's a big upturn during the worst time to be in,
Right.
because something had happened
Right.
that kind of shifted that. So you can't worry about that stuff. So if you implement something that's seasonal, first and foremost, if you pick a strategy, you got to stick with it. I tell people all the time, if you're not willing to stick with a strategy for an entire year, don't bother. Just don't, because you can't play this month to month or quarter to quarter. And whatever Bloomberg said yesterday, and the Fed's coming this, and I'm going to keep changing my strategy based on all these inputs. Well, nothing's going to work. It doesn't work that way. That's like changing your diet every week because you want to lose weight, right? It doesn't stick with some strategy. And I would say 2 years is better. If we're talking over a 30-year career, give or take. Right. If you try a strategy for a year or two, I'd say 2 years is best. It gives you honest feedback. Do you resonate with that strategy? Does it work for you? Right. Then maybe try another one for a couple of years. These are all great things to do earlier in your career. Yeah. But if you're not earlier in your career, maybe you only do it a year, but you got to give it a year, and you cannot stress over the fact that the strategy isn't perfect. There is no perfect strategy.
No, absolutely not.
Buy and hold's not perfect. Very active management's not perfect. I would categorize that as generally what we do. We try to squeeze every bit of juice we can, and then there's stuff in the middle. Yep. And not one of them is always going to perform perfectly with every market.
So, perform is the key word. If you think performance means I've lost money relative to my all-time high, you're in a place where you're going to fail every time.
Yeah.
You cannot trade. You can't day trade the TSP.
Yeah, it's just not going to work. And the best you can do is grow your account balance over 30 years. That's really what you want to do. If you're in a time span in your career where the market was more favorable, it makes it easier. Yeah. And we've been there. We've also been in times where it was not favorable. And if you weren't actively managing it, right, whether it's with a strategy like Jerry just pointed out, or one like ours, which is very similar to this, it's not we're not just doing it twice a year. But right. the reasoning behind why this strategy works is historically these months are historically the worst. These months are historically the best. It's still working off charting. Yep. Right. It's still working off technical analysis and historical data, but it's just making it less active. Yep. And there'll be years where you have just killed it. Yep. And like years where you might be flat or a little down. And that's way better than being way down. Right. Most of those, as you saw go back to that one where it shows the comparisons, because I like that one. Don't listen to us. Just look at that. Yeah. Right. These folks did a lot of research. This only goes back to what
1950.
But as of the date, I can't see that.
December 31st, 2023.
Yeah. Okay. Well, it's really. I thought that was 2003. I can't see the screen. Yeah. Well, yes. That's about all the data you need. Right there. Buy and hold versus being in the worst time versus this strategy. Yeah. And if that doesn't tell you the story, then you're missing it. Then you just don't want to hear you don't want to hear the news. I tell people all the time, some of the least active strategies are the best. You still got to be active, though, because passive means you're paying no attention to it. Right. And you're going to regret that in certain circumstances, especially over the course of 30 years.
That's where you have to start, right? If you're going to pick a strategy that is based on long term, call it buy and hold. Because the most common is that people are like, well, the market always goes up, and therefore I'm going to stay in the C fund for my whole career because the market always goes up. If we've obviously shown, and everybody kind of understands, the market doesn't always go up. It depends on your time frame, right? That there are certainly times when the market goes down, times when it goes up. It depends on your time frame. So if you're starting your career and you're saying, okay, over the next 30 years, it's more likely that the market's going to be higher than it is now, that's probably a true statement. and you keep contributing, and the market does what it does, and you keep contributing, that works. When you get close to retirement, and a lot of people say, if you're 5 years or more from retirement, just leave it in the C fund and let it ride. That is the most dangerous statement that you can tell people. Hopefully you understand that if you're retired or close to retirement, the advice of just let it ride in the C fund is not something you should be listening to. It's pretty much as simple as that. But this is a pretty good strategy if you acknowledge that there are going to be times when it doesn't work, and times when it works very, very well. In the past couple of years, it's worked extremely well. Okay. All right, so Bitcoin. So 2 weeks ago, we threw up this chart of Bitcoin. There's a lot of talk about Bitcoin, and obviously it's exploded higher this year. So we put up this chart of Bitcoin. It was in this range. The reason we put up this chart is because it was within the range of the prior highs from the last two major tops in Bitcoin, right? So once this line is probably the most important line on the chart, there was a lot of support on all the pullbacks, right? And once it broke through there, then it became resistance, couldn't get above it until it did get above it here. So this was the best time to get back into Bitcoin recently, right? So Bitcoin explodes to the upside, and it hits resistance at the prior high, okay, and then pulled back. But it stayed within the range. So right now it's in this range trying to break out to the upside. And that was like 2 weeks ago. So if we fast forward to where we are now, yeah, we got outside that range to the upside. And that's definitely bullish in the big scheme of things. But we've since pulled back into the range. Okay? So, which doesn't negate, sort of does negate this, to be honest. It kind of negates this. We're back in this range, and we need to get back above, say, 69,000 before Bitcoin really has a chance of moving higher. On the positive side of it, if you're looking at an Elliott wave perspective of this, this is a 1, 2, and then 1, 2, 3, 4, 5 for a 3, 4, 5. Like Bitcoin should be going much higher. From my Elliott wave count of this, it should be going much higher. If it gets below this channel, it's a problem. But I expect it will go much higher from here. And like we said, you can do Bitcoin in the mutual fund window if you want to do that. But again, if you're retired, you can see the massive volatility. This is a daily chart, so the massive volatility. There are some big pullbacks on a percentage basis in Bitcoin all the time. Okay. All right, so the C fund chart for the week. So again, this is a weekly chart of the C fund. There isn't a whole lot to talk about. I mean, the market has been going higher. We've had, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 20, 21 weeks. 21 weeks since October of last year. Since this big green candle right here, 21 weeks. And out of that, we had 1, 2, 3 down weeks, right? And some of them were barely down at all. But we had three red candles. That is an unbelievable. I mean, you don't see that. We're only going back here to end of 2020, but even this huge rally that we had in 2021, you don't see anything like this. I mean, that is unbelievable. So, like Hanum was talking about before, the risk now is not being in this rally. At some point, it's gonna peak. You're gonna get a red candle. It's gonna break this trend line, and then now the risk is much different, right? That's what I was saying. The market is gonna tell you what the risk is. Once it starts rolling over, then the risk is being in the stock funds, right? Once it starts rolling over, it's likely to roll over in a hurry. But there's no indication of that happening anytime soon. So if you're looking at it, this black line is the 10-week moving average line. And the blue line is the 20-week moving average line, okay? So if you kind of go back here, this rally in 2021, most of the time when there was any kind of pullback, it got support at that 10-week moving average line, right? Almost always. And when it didn't, it came down to that 20-week and got support there. It wasn't until we got a big breakdown through that 20-week that the market started going down. So, and it's the same thing here. Once we got that breakdown through that 20-week, the market went, significantly lower. But where we are right now, I mean, you can do all the hand wringing you want and say the market's too far overextended to the upside. There's all these reasons why the market should roll over, and all that is true. But until the market actually shows us that it's rolling over, the risk of not being in outweighs the hand wringing of what's going to happen if and when it rolls over. And you'll see it. The first indication will be we get a weekly close below that 10-week moving average line. That should be the first red flag. And then a weekly close below the 20-week moving average line. Now it's more likely than not that the market keeps going lower.
It's on like upon a neck bones. As we say in the South. It's down.
I don't have any idea what that means.
I barely do.
All right. Okay, so I just threw this one extra in also. This is a daily chart of the C fund. Okay, so this was the breakout from beginning of November, end of October last year. Once we got above that 20-day moving average line, this is a daily chart. Every time the market pulled back to that 20-day moving average line, it found support, right? Every single time. So until price closes below that 20-day moving average line, the trend is up. This is as clear as, it can't be any more clear than this. I don't know if you want to watch one chart on a daily basis, this is it. Until price gets below that 20-day moving average line, the trend is up. This is what, they say buy the dip, right? Every time price gets down here to that blue line, if you buy it, more likely than not, you're going to make money over the next couple of days. We keep getting higher highs and higher lows. So again, until we get below that 20-day moving average line, and that's really the first red flag. That doesn't necessarily mean that we can't do something like this and move higher. Yeah,
I was going to point that out. If it does drop below that, generally speaking, you might just be getting a little correction.
Yep.
You got to keep your eyes on a few more indicators.
Yeah.
But if you're completely risk averse, then that's a line you can draw. You can say, that's my line in the sand. Drops below that 20-day, I'm out. And I'll sit on the sidelines until it figures itself out.
Yeah.
There's nothing wrong with that.
Sure. If we go back to here, you could say, as long as price is above that 20-day moving average line, I want to stay in the stock funds. I don't want to be in the stock. Once it gets below it, I don't want to be in there. When it gets back above it, I get back in. This was a head fake, right? You would have gotten in and out here, and it would have been frustrating. But if you're out of the market below the 20-day, right? You're in the market above it, out of it below it. This was frustrating. There's a lot of moves in here, but if you stay with it, you get above the 20-day there, and you caught this entire move higher. So it takes work. If you want to do it on a daily basis, it takes a lot of work. It's not necessary. I would argue people have better things to do and do it on a weekly basis rather than a daily basis, but it's the same idea. All right. That is all I got. If you guys have questions, definitely hit us up. Obviously, we use the questions people ask in the group to we get a lot of good questions in the group, and the ones that I think are applicable to the most people, we try to use on the show.
Yeah, absolutely. If you have any questions, put them in the comment section wherever you find the video. If there's no comment section, shoot us an email at support@growmytsp.com, and support team will get it over to us. We love questions, love comments. Give us some feedback. Tell us what you like, what you don't like.
Yep.
If you do like it, share it with your friends. If you don't, share it anyway.
Awesome.
All right. Hope you guys are having a great week, and looking forward to some summertime weather.
Exactly.
See you guys soon.
Out of here.